Normally, I don't focus much on short-term market movements or how investors should be behaving in the short term. However, I have been receiving a lot of questions from friends and readers about how to navigate this soaring bull market. And so I thought I will create this episode to share my thoughts on what you can do in such euphoric times when nothing seems to be going wrong with the economy, the markets, and your portfolio. First off, the market is soaring and I'm sure your portfolio is looking great. Congratulations for that. It's exciting, but it's important to not get swept up in the hype. I know it's tempting to think about cashing in or making big moves at this point of time, but the key to long-term success in investing is consistency and discipline. So whatever the markets may be doing, just stick to your investment strategy. Whether you are into value investing or something else that works for you where you are not taking large potential risks of losing your capital permanently, just stay the course. Your investment strategy is your roadmap, guiding you based on your financial goals and risk tolerance, not the stock market's latest highs and lows. Another thing I am advising my friends is to focus on quality over trends. It's easy to get excited about the latest hot stock or market trend, but remember to focus on the fundamentals. So invest in companies with strong balance sheet, consistent earnings growth, and solid competitive positions. And it does not matter whether they are large caps or mid caps or small caps. These are the companies that will likely weather the ups and downs of the market much better than the market as a whole. Think of it like this. You're building a solid foundation for your financial future, not just chasing the latest shiny hot stock. After all, that's not what investing is all about. Another advice is to have adequate diversification as your friend. Even when the market is hitting new highs, spreading your investments across different asset classes and industries can help manage risk. If your stock investments are doing well, having some bonds or non-equity assets in your portfolio can provide balance and stability if the markets take a bad turn. It's all about not putting all your eggs in one basket. So look at your asset allocation. If you were fine with a 60-40 equity debt allocation and that is now 80-20 or 90-10 due to the stock market surge, try and go back to 60-40. Do not change your asset allocation just because a particular asset is doing much better than others. That's not what asset allocation is about. Rebalancing your portfolio is an important step at this point of time. Now let me talk about market timing. I have said it in the past and will say again, it is a trap. Trying to sell at a peak and buy at the bottom is incredibly difficult, even for the best of investors. So instead of trying to time the market, focus on staying invested. The real power in investing comes from time in the market, not timing the market. So let your investments grow and benefit from the power of long-term compounding. It's like planting a tree. It takes time to grow, but the rewards are worth it. Another thing I advise you to do is to stay informed, but also know that there's a fine line between being informed and being overwhelmed by noise. The media loves to sensationalize market highs and lows, which can lead to emotional decision making. So stick to trusted sources and focus on the bigger picture. Understand the broader economic context, but don't let every headline dictate your moves. Keep a cool head and remember your long-term goals. And finally, let's take a lesson from history. Markets go through cycles. They rise, they fall, but over the long term, they generally trend upwards. So look at past market cycles and see how investors who stayed the course fared. It's a great way to gain perspective and confidence. Knowing that the ups and downs are normal can help you stay calm and stick to your plan. One more thing to keep in mind is that when making money in the stock market starts to feel easy, like it is now, it is usually a warning sign. If everyone around you is talking about how easy it is to make money in stocks, be very cautious. Investing is not an easy game, and overconfidence can lead to poor decisions. When people start believing that the market will always go up and that they cannot lose at all, it often does not end well. So stay humble and remember that the market can be unpredictable. Speaking of humility, it is also important to keep envy in check. I understand that it's natural to feel envious when you see others making money faster, especially in a booming market. But chasing after someone else's returns can lead to risky decisions. So stick to your strategy and remember that everyone's financial journey is different. Your focus should be your own financial journey and goals, not on outdoing others. Lastly, respect the role of luck. Sometimes market success comes down to being in the right place at the right time. So acknowledge that luck plays a part in investing. And do not assume that all your gains are solely due to your skill. This mindset helps maintain humility and prevents overconfidence, thus keeping your investment approach grounded. And to help you stay calm and grounded, I recommend a few great books like The Intelligent Investor by Ben Graham, Thinking Fast and Slow by Daniel Kahneman, and The Psychology of Money by Morgan Housel. These amazing books offer timeless wisdom and insights that can help you navigate the market with a clear mind and a steady hand. So finally, what's the key takeaway when the Indian stock market is hitting new highs? First, ignore what the market is doing and stay disciplined. Stick to your long-term investment strategy. Focus on quality. Diversify adequately. Avoid trying to time the market. Rebalance your portfolio occasionally. Stay informed but avoid the noise and learn from history. And most importantly, do not fall into the trap of thinking that making money in the market is easy. Keep envy in check and respect the role of luck in your investment journey. Before I end, let me share a quote from the noted speculator and trader Jesse Livermore, who said, "There is only one side of the stock market, and it is not the bull side or the bear side, but the right side." Then a Buddhist proverb says that if we are facing in the right direction, all we have to do is to keep walking. This thought captures the essence of how we can train ourselves to be calm and patient in life and while investing our hard-earned money, whatever be the situation. When euphoria or fear runs high, do not run with it. Instead, keep a calm mind, think well through things, and be patient. Avoid hasty decision and keep playing according to your plan. Things will go bad after good times, like they go good after bad. But if you maintain your sanity before they good or before they go bad, you will not be excessively elated or disturbed when they actually do. That's what intelligent investing should be all about. Thanks for tuning in today. If you found this episode helpful, please don't forget to like, share, and subscribe to my channel. Let's continue our journey towards thoughtful and disciplined investing together. Until next time, thank you so much.